Bhavin Shah is now joining in. He's the founder and CIO, CEO of Sameeksha Capital, but he's been watching IT for the last so many decades now. Bhavin, thank you very much for joining in. Before we get to Tata Elxsi, first the big one, Infosys, and give us a summary of what we've seen from TCS, Wipro and Infi now.
I think there is increased uncertainty and weaker outlook from these companies. That is what I can see, and I think the commentary guidance is confirming that, and this is perhaps not even fully accounting for the potential weakness that we might see in the sector. And I think we have already seen the growth slowing down last year. I think Gen AI is kind of causing a new equation. Many of the past transitions or technology shifts were positive for Indian IT services, whereas AI is potentially negative, and I think that is where the issue is. And then on top of that, we add the economic uncertainty that has come up because of the tariff war. So I think, in summary, it is a, and I compare current situation to start of COVID, because valuations, from my standpoint, at least from a cash flow perspective, are similar to the start of COVID, almost there. But I was very positive and very excited about by owning the stocks going into COVID. I don't think that excitement is there today. There is still a fair bit of question marks on the growth outlook.
So what are you advising clients now? Should one be owning IT at these levels? And if they do have IT, is it time to trim? You want to say something?
No, I was just saying, sorry, Bhavin is his own client. I mean, he's
managing money. He's managing money. And so what's the call now on?
Yeah, so what I can say is that in our portfolio, we don't really own much of IT stocks. We have very, very small exposure. We have found the sector to, the stocks to be fairly expensive for the last some time. And while they are getting attractive, as I say, but the growth is a question mark. So we would continue to sit away, and if people still have it, I think whether or not to trim here or not is a difficult one. But yes, if somebody's overweight, it is worth still going, correcting, especially in the expensive leg of the sector. Some of those mid cap names, which were considered to be high growth, and and both companies and the investors were extrapolating 1 or 2 years of super growth in COVID to sort of 5 and 10 years, and that is, I think, is reversing now. So I think unless you are seeing, and I'll give a simple thumb rule, unless you are seeing an IT stock available at 5 to 6% free cash flow yield, be careful. You probably will see more downside.
And what is it currently at? The free cash flow yield?
I think the likes of Infosys are at that number, but the question mark is growth. And I think, but some of the other ones, the mid cap high growth stocks are not that level yet, so there could be more downside.
So that's like a filter, starting point, right? In that sense, and then you talk about other stuff. Bhavin, good to see you, and it's been a while. And congratulations. I think your portfolios have done very well over a sustained number of years. And we'll talk more about what you are doing. But anything out there in terms of so much technological change, right? And how's any other places it's likely to show up? You track a lot of small mid cap stocks, etc. as well. And there were a few names on the IT hardware side, data center plays, etc. Anything which you like?
I mean, we are very much interested in finding value. We add as well as growth. Combination of that. So we have some exposure to companies that are more in the distribution part of the IT food chain. So not really affected by these technological changes, but in fact, increase in demand for some of the new hardware might even be positive for them, and they remain available at very attractive valuations. So we still own them, and I think the other aspects will be the IT related. You could say the KPO type of businesses, but they are catering to a very different, let's say, healthcare segment. And I think there, maybe there is still fair bit of growth opportunity. And so if the valuation is right, we would still own it. But I think overall, the technology is enabler in many ways. I think changing the consumption pattern. Digital music is something we have liked before, and we continue to like. So we have some exposure there. And I think some of the companies that are basically platform plays, they have experienced lower growth. They act as an interface between the users of services and the service providers or goods. And the slowdown in the economy perhaps has affected the growth, but then they are also available at very attractive valuations. So we own some of them as well. So more domestic play, I would say, in that context, than companies. I mean, I think we have kind of done a scan through our portfolio to see how much is the exposure to for example, the US, and we try to kind of stay very low on that right now.
All right, Bhavin, thank you so much for joining in. I was curious about the digital music plays. There are two listed names here. We'll talk to you about that in detail on another occasion. But as of now, thank you so much for your call on the IT sector. Let's